Checking accounts, we talk about the different kinds of accounts, different account features, what to look for when you're shopping for the kind of bank account you want. How interest works. I'll teach you how to balance your checkbook and read your account statements, things like that. But first we have terms that you're probably already familiar with, but I wanted you to know the official definitions of these. So a checking account is a bank account that allows you to make deposits and withdrawals and transfers on the funds in that account. Now, not every account allows you to do this. Most savings accounts have restrictions as to how much or how often you can take money out of the account in certain periods. Like some of them have you can only make 3 withdrawals within 30 days. So they're not free. You're not free to do whatever you want as far as taking your money in, taking your money out, transferring, things like that. There are some types of accounts where you can't touch your money for 5 or 10 years, depending on the terms of the account. But with a checking account, 99% of every checking account out there has no limitations on what you're allowed to do with your money. Now, there are some checking accounts that do have limitations, but those are usually very specific types of accounts, interest-bearing checking accounts, and things like that. But like I said, most checking accounts, you can do whatever you want with your money at any time. A check is actually a written order. So when you write a check, which most of you probably don't actually do anymore, because people don't write checks anymore, but if you do write a check, what you're doing is you're writing a contract, essentially, telling your bank to pay money to whoever the check is written to, or to their account. Electronic funds transfer is the process of moving funds electronically from one account to another. It's also known as an e-check. This is not the same thing as using your debit card or your ATM card to transfer money. This is an electronic check. So if you used a bank account with bill pay and you order the bank to pay your electric bill out of your account, that would be an electronic check. So it's a little bit different than a debit card, and it's processed a little bit differently. The payee is the person that receives the money, so the person or the business that gets the money, and the drawer is the person that is paying the money. And I'm not really sure why you're called a drawer, other than I'm thinking it's like a cash register drawer and the money comes out and goes, but I really don't know if that's where it came from. But so if you see drawer or payee, drawer is the person paying the money. Any questions on those terms? Like I said, I figured they're probably mostly familiar. Okay, so check clearing occurs when the account in question had enough money to cover the check and the check has been paid, so now the money is no longer in the account. So that's what is called clearing. Deposit slip, again, sort of like checks, these are kind of going away. My bank doesn't even have them anymore or use them, but a lot of banks still do. It's a slip of paper that you fill out to make a physical deposit at the bank. So if you actually walk into the bank to make a deposit, most banks, I think, still have them. You fill out a piece of paper that has your account number, your name, your address, and then you list your deposits, cash, and then you list each check individually, and then you total it all up, put it all together, give it to the teller. But again, like some banks don't have them anymore, my bank doesn't. Direct deposit, I'm sure most of you have heard of direct deposit already, but deposits are made electronically. They are validated before the funds are available. So let's say you get your paycheck direct deposited. Before they actually release the funds into your account and so you can withdraw money or spend it, they validate it to make sure that the money from the account that the deposit's coming from is actually there and will transfer. Not everybody can do direct deposit. Direct deposit is paychecks, government checks, structured settlements, things like that. Businesses can make direct deposits. I, as an individual, cannot set up to make a direct deposit into somebody else's account. A hold is put on a deposit until it clears. Typically speaking, direct deposits, government checks, if you get a regular paper paycheck and you deposit it in your bank all the time, these things they don't put holds on because they are familiar, they know them. If your great aunt Agnes from Saskatchewan sends you a birthday check, they'll put a hold on it because it's from out of state and it's a personal check, and so they want to make sure it's going to clear before they release the funds to you. Really large checks. I once got a really large check from the Treasury Department in California, actually, and they put a 14-day hold on it because they weren't used to handling those types of checks. So really large checks will have holds put on them, out-of-state checks will have holds put on them, personal checks will have holds put on them, and it can be 1 to 14 days or longer. If it's an international check, it could take up to 30 days to clear and for the funds to be available in your account. And then endorsing. If you physically deposit an actual check into your account, you have to sign the back. You guys have all done that? Yes? Maybe? You have to either sign it or you can do a stamp, like a for deposit only stamp with your account number, or you can write for deposit only in your account number, or if you're getting direct deposit, you're actually electronically endorsing every check. When you sign that direct deposit paperwork, that's what you're doing. And that is before you can cash or deposit the check. If you don't endorse the check at the discretion of the bank, they can reject the deposit. This has happened to me, where I deposited a check through the ATM, but I forgot to sign the back of it. And the money was in the account, but the bank went, oh, she didn't sign this, and they stuck it in an envelope and mailed it back to me. Just be sure you always sign them. Okay, because they can refuse them if you don't endorse them. Some of them don't, some of them do. It just sort of depends on the. With canceled checks. Canceled have 2 L's. I think I misspelled canceled. Oh, well, anyway. A canceled check is different than a voided check. Okay, we'll talk about voided checks too a little bit here. A canceled check has been paid. So I write check number 1221 to Joe Bob's Plumbing, and then he cancels it, or he cashes it or deposits it. As soon as the money comes out of my account, that check has been canceled. That check number was 1221. I can never use check number 1221 again. That's why checks are numbered. They can only be processed once. So if my bank sees another check 1221 for any amount to any other person, they're going to deny the check because they've already used check 1221. Okay, it's been canceled. It's no longer valid. Voided checks are checks that, let's say I go to write a check and I make a mistake when I'm filling it out. So I write void across it and then I don't use it because I filled it out wrong. For whatever reason, I put the wrong amount, or I put the wrong date, or I spelled it wrong, or, whatever. So that's the difference between canceled and voided. The bank never sees your voided checks. They just disappear into the ether. Okay, insufficient funds, also NSF, you'll see that, is when your account does not have enough money to cover the check. They are returned or dishonored, or they bounce. That's what happens when, if you write a check, let's say you write a check for $100 and you have $20 in your account, but you wrote the check for $100. It hits your bank, you only have $20 in your account, your bank says no way. Sends the check back to whatever bank was processing with them, sends it back, rejects it. Then what happens is you get charged a fee by your bank for the insufficient funds, usually right around $30, 25 to 35. So that $20 you had is now gone. and maybe you're negative 15. The $100 that you paid to somebody that bounced didn't get paid. So let's say that was your electric bill. You still now owe that $100 electric bill, plus they're going to charge you a fee for bouncing the check, usually right around $30, 25 to 35, some of them up to 50, and you end up in the hole. Unless you have overdraft protection. Overdraft protection will pay a check even if you don't have the money in your account. And there's two types of overdraft protection. One comes out of your savings account as a transfer. So if you wrote a $100 check but you only had 20, 80 of it comes out of your savings and covers the check. Usually there's a fee, although it's much lower than a bounce check fee, $5 to $10 for that service because they had to process the transfer instead of you going in and doing it yourself. Or they'll charge it to your credit card that you have on file and charge you a small fee because they had to push some buttons. Sometimes with some accounts, depending on the bank, depending on the type of the account, and depending on the amount of the check. Like I write that $100 check, but I only had $20 in my account. Some banks will go ahead and pay it, especially if you don't have a history of that. Then they'll make your account negative 80, and they'll charge you the $30 fee, so then your account's negative 120. But your electric company's none the wiser, so it just sort of depends. Yeah, of course. So it just sort of depends on a couple different things. Usually, if you have a history of overdrafting your account, they'll stop doing that. If you're already negative, they won't pay it at all. And if it's for a large amount, let's say you have $20 in your account, you write a check for $1,500, they're not going to do that. But if it's a little bit over, some banks will just go ahead and pay it like as a courtesy, charge you a giant fee, but they'll just go ahead and pay it. So that's sort of, there's a lot of factors that come into play there. The largest one, of course, the largest two being the history of your account and the amount of the check. ATM is the automated teller machine. So the magic boxes where you put your card in, you get the money out. Those are called automated teller machines because back when these were first invented, bank tellers, this is an automated teller, not a real person. It's like a robot. It gives you 24-hour access to your account, but there are limitations. You can't, if you have a Bank of America account, you can't go to a Chase ATM and make a deposit. You have to go to a Bank of America ATM to make a deposit. You can withdraw money from any ATM anywhere at any time, provided you're willing to pay the fees. You usually get hit with a double whammy. The ATM that's not your bank will charge you a fee, $150 to $250. Then your bank will charge you a fee, $150 to $250-ish, for not using their ATM. So that $20 you withdrew from wherever ends up costing you an extra $5 in fees. So just be aware of that. A lot of times you don't think about it, you're like, whatever, and you just keep pushing the buttons until they spit the money out. But do that enough times, that adds up. That like $5 every time you use another bank's ATM, it adds up. So just, And then of course your PIN number is your identification number that you use at the ATM or with your debit card to make sure that you're the right person using your account. In theory, we all know that things happen and the ATM pins get stolen and things. Now, back in the day, a couple years ago, there was not really such a thing as a debit card. So you had an ATM card for your bank. It was like a bank first ATM card. You couldn't make purchases with it. It wasn't like the Visa cards that you have now where you can swipe them and it's like a Visa. You could only get money out of the bank or put money into the bank. Then they came out with the Visas and the MasterCard debit cards, and now you can use them as an ATM card or you can use them as a Visa or MasterCard. I don't think there's any American Express debit cards. I know there's like an American Express prepaid card, but they don't make, I don't think they have like a bank account debit card. So, and that gave everybody a lot of freedom because the places that, okay, So you have a maintenance fee, or otherwise known by, as a monthly fee. This is not the same thing. This is not the same thing as fees that you get charged for using the wrong ATM machine or overdrafting or things like that. This is a monthly fee that gets charged the same fee every month on certain accounts or if certain criteria are not met. For example, CFE, Central Florida Federal Educators Credit Union, has, if you don't use bill pay on their account in a 90-day period, you have to use it at least once in a 90-day period, or you get charged a fee of $6.95 a month for monthly maintenance fee. However, if you do use bill pay at least once in a 90-day period, then you don't have a fee. So that's kind of the criteria. Some of them have minimum balance criteria. Some of them have minimum transaction type things. It just sort of depends. And then some accounts have no monthly fee at all. It just sort of depends on the account type. Interest. Now, the majority of checking accounts out there do not pay interest. That's usually a savings account or money market account or CD and all these other kinds of accounts we'll talk about. But there are some checking accounts that do pay interest. Interest is a percentage of the money in the account. So however much money you have in the account, they take a percent of that. Over a certain period of time, depending on the way they have their interest structure set up, it could be daily, monthly, annually, semi-annually, and we'll get into all that later when we talk more in depth about interest. And then it's paid into your account, usually monthly or yearly. A basic checking account is the most common account that anybody has. Most people have a basic checking account. Basic checking account is an account that allows you to move money at will, so you can put as much money in or you can take as much money out, as long as the money's there. They don't care how many transactions you have. Most pay no interest. They generally don't have minimum balances. Just a really basic, simple type of account. Then there are interest-bearing checking accounts, and an interest-bearing checking account does pay interest, but usually has a pretty high minimum balance, meaning that you have to keep $500 or $1,000 or $5,000 in the account at all times. You can't spend that money. It has to sit there. You can spend anything over that, but you can't touch that minimum balance amount. If you go below the minimum balance, so for example, if you have an account that has a $500 minimum balance and you go below that, you get charged really high fees and you lose your interest. So it costs you double. Most of the people that have these accounts have so much money they probably don't need the interest, but that's the way life works. You have free checking accounts. Free checking accounts have no minimum balance. They have no monthly maintenance fees. Now, that doesn't mean there are not fees. They're just not monthly fees. You'd still get charged fees for using the wrong ATM or bouncing a check. Those fees still apply, but they cannot charge you a monthly fee. And the Federal Truth in Savings Act guarantees that if they tell you the account is free, they cannot charge you a monthly fee. If they do, they are in violation of federal law. And this came about because there were some really sketchy bank practices back when this act came into being, where people were being told one thing and then the banks were doing something else and charging them a lot of money, and it was unethical. And so a law was written to prevent that from happening anymore. So if they say free, it's free. It has to be free.
Is there any qualifications? You said that there's very few banks or banks.
Okay, so a joint account is an account owned by more than one person. Like your parents probably had a joint account. They don't have to be related. You can go to the bank and open a joint account with anybody if you want to. The owners of the account all have equal access to the account and equal liability. So if you and say your roommate decide to open a joint bank account to pay rents and bills with or something, I don't know. You both have equal access to the money, so either one of you at any time can go in and withdraw money, put money in. But if that account goes negative or something bad happens with the account, you are equally liable. So if one person in the joint account takes all the money and the account goes negative, both people are liable for it. So or three people, however many people on the account are all equally liable. My recommendation on joint accounts is that you have joint account with someone that you have you're related to, like a spouse. Yeah, you gotta trust them, cause you're talking about.
Is there like, another requirement would probably be like a physical contract?
Yeah, you guys could have contract with each other, but it would not be legally binding.
Right, so if anything happened that was not of your fault, you could take them to court, and that would be.
It's not, you guys have equal ownership, equal liability, it's not legally binding. So even if they did something, you're still liable.
You're liable to the bank, but say you paid your responsibility to the bank, could you then take the contract?
You might be able to take them to court, but you don't actually have a lot of legal grounds there, so it would be up to the individual.
With the bank.
Yeah,
Right,
yeah,
okay.
so the liability and the access and the ownership are all equal as far as the law is concerned.
Right.
When you have that joint account. So like my recommendation, on joint accounts is that it's somebody that you have to have a high level of trust, because you're talking not just about the money in the account, but you're talking about credit ratings.
Right.
You know, because if something happens and then the bank reports it to the credit bureau, that affects your credit too.
Right.
So you want to, like, you know, family members, parents and kids will have joint accounts together or something, or yeah, your spouse, you know, like, just, there's got to be a lot of trust there.
Right.
When it comes to your credit,